this is a kind of longest story. I started in 1998 as a student. I just was getting into my BCom first year, and there was a summer vacation before that, and I started watching CNBC, was a huge fan of Udayan Mukherjee, and so I took a little bit of money from my dad, and I started investing in Reliance, HUL, Britannia, Colgate-Palmolive, studied the book, studied the financials, debt equity ratio, said, okay, great investment. And then slowly, as I was making money, I got more and more excited about it. And then I got sucked into this whole momentum trade of the Ketan Parekh shares. And I invested in all the Ketan shares. You name it and I had it. I had HFCL, Global Telesystems, Satyam, Z, Pentamedia, DSQ Software. You name it and I had it. And then in 2001, it all crashed and I was left with no money at all. It was really, really shocking and it really scared me. So I kind of stopped investing and I said, okay, let me just get back to my books and start studying. So I was studying, I did my MBA, then I got into business. Finance was left to financial advisors. And I was like, okay, this is going well, let's just continue like this. And then again, COVID happened, 2020. All of us are sitting, doing nothing, back to CNBC, back to watching this. And then I was like, okay, I can't be making the same mistakes again. Let me do this differently this time. So I actually obviously got back to reading financials, balance sheets, management, and that's how I did it. So obviously in the 2 years of COVID, we all had a lot of time on our hands. And but now when work has started, everything is reopened, you need some time for it. Let's not deny that. For being doing your own investments, you actually need to give it some dedicated time. I do that. I do that even now. Initially, I had only 20-25% in equity. Then once I started investing on my own, I put in another 10-15%. Last 2 years were great for all of us. So that investment became it was a decent growth. So I invested a little bit more. Today, I think I have around 45-50% of my entire investments into equities. Execution challenges, yes, because I am obviously not an expert. And for me to have a very diversified portfolio, like getting into too many different sectors, is a little tough. Because once you get into a sector, you really need to know the ins and outs of that sector. So what I tend to do is I've kind of shrunk it. I said, okay, I'm going to be strong in IT, banking, consumer durables, discretionary products, and a little bit into the future, like I'm looking at the drone sector right now, I'm looking at EV. So I've kind of kept my studies to that. I've not really got into pharma and things because there is more to study. I don't have that kind of bandwidth. That's one. The number two is the SEBI keeps changing the margin rules. So that kind of affects your trading, if you are trading as well as investing. So those are the execution issues that one faces. Never to follow tips, never to have, not gut over numbers. I mean, numbers never lie. Read your financials, look at the corporate governance of a company. That's extremely important. And, the market is extremely efficient. You will never be able to make those unexceptional, crazy profits in the short term. Number one is value investing. Please do not go after just growth investing and looking at momentum and buying anything at crazy valuations. Always look for real value, look for the PE of the industry, look at what is the intrinsic value of your particular company. Is it at a discount? Then yes, buy it. Don't buy something because it's going up. Because momentum, you know how right now how the fall has been, right? The growth segments, the high momentum shares are the ones which have fallen. Compare a Mindtree, see where it is now, see a Persistent System. All of them have really, really fallen. So you need to kind of figure out and see, you always have to buy value. If you buy value, even in a falling market, you're not going to really have that kind of damage. Number one. Number two, governance, corporate governance of a company is the most essential. I think we all have seen it, how the Tatas have kind of done it all in the last 2 years. During COVID time, they have kind of revamped everything. So much has been done. See how Indian Hotels is doing, see how Tata Motors is doing. So if the governance is good, you're going to definitely see that even if you don't make money in the short run, over a period of 4 to 6 years, you're going to make money. Stay invested for long. Don't think you're going to make money in 1 or 2 years. Minimum, I would say, is 3 to 4 years, and 7 years is when you actually start seeing decent money.